For activity 59, I'd like you to first try out the activity. It's fairly self-explanatory. And just a little hint here, you'll need to do trend analysis again. So what you would do is, let's say that year 5, for example, would be your base. And if you were to do a trend analysis on sales revenue, you would have 100 here. And for year 7, you would have 98. So then here, sales revenue in year 6, your trend analysis it's 1589. It's obviously higher, but in year 7, it's actually lower. So in year 6, sales revenue increased, and in year 7, it decreased. So take 5 minutes right now and please complete the whole thing, and then continue to watch the video. Okay, good job. Let's do a little bit more trend analysis to see what's going on here. Cost of goods sold, the trend analysis for year 7, i.e. 876 divided by 905 is 97. I'm just doing some backup math here. Gross profit, 599 divided by 597 is still 100. Operating expenses, 518 divided by 453 is 114. And 81 divided by 144 is a not very good 56. On the balance sheet, accounts receivable in the second year, 458 divided by 374 is 122. And 23 divided by 29 is 79. So if you were to do the total here, 374 minus 29, accounts receivable net is actually here 345. In the second year, it's 356. I'm sorry, that's called year 6. In year 7, it's 435. So now, cost of goods sold. In year 6, we can see cost of goods sold went down. In year 6, cost of goods sold rather increased. But in year 7, it decreased. Operating income increased in year 6, but decreased in year 7. And accounts receivable in year 6 increased. And in year 7, interestingly enough, even though sales decreased, accounts receivable continued to increase. It's now at 458 from 374. And the allowance for bad debts increased in the first year from 29 to 31. That's year 6. And in year 7, it decreased to 23. So what seems very strange here is that even though sales is decreasing, well, let me put it this way. As sales decrease, I would expect accounts receivable to decrease. But instead, accounts receivable is increasing. Furthermore, it seems strange that the allowance is decreasing. Because even though accounts receivable is increasing, if accounts receivable is increasing, as it is here, I would expect the allowance, the more people owe you, the less likely, the more money you're not going to collect. But here you can see a 22% increase in accounts receivable, but a 21% decrease in the allowance for bad debts. And that seems very strange. The next thing to do is the accounts receivable turnover ratio. And the formula for that, if you looked it up in the book, is sales divided by accounts receivable. And in this class, again, we're going to use, as we usually do, we're going to do we're going to use ending accounts receivable. If you want to do this in the technically correct way, you're going to use average accounts receivable. Beginning receivables minus ending plus ending receivables divided by 2. But in this class, to keep it simple, we only use the ending accounts receivable. So accounts receivable, 1475 sales revenue, divided by accounts receivable of 458, gives you an accounts receivable turnover of 3.22. In year 6, 1589 divided by 387 would be 4.11. And in year 5, 1502 divided by 374 gives you accounts receivable turnover ratio of 4.02. And the allowance as a percentage of sales revenue, I think they're asking you for that right now, right? Allowance as a percentage of sales revenue, that would be 23 divided by 458 is 1.56%. Here it's 31 divided by 387 or 1.95%. And here 29 divided by 374 is 1.93%. What does this mean? Well, accounts receivable tells you how many times a year on average you collect your receivables. So the higher it is, what you want with accounts receivable, of course, is you want to loan money to companies and collect the money fairly quickly. So the more often you collect your receivables on average, the higher the turnover. So an accounts receivable turnover ratio of 4 would indicate that you go through the cycle of selling to a customer, collect the money, sell, collect, sell, collect, sell, collect. You go through that cycle on average 4.02 times a year. And you want that to be quickly because you want to collect the money quickly. That's what turnover is all about, is using your assets as productively as you can. And you can see what happened here is accounts receivable increased, and it increased even more. I mean, accounts receivable turnover increased and increased even more in year 6. But in year 7, as sales went down, accounts receivable turnover also went down. I'm sorry, sales went down, accounts receivable turnover ratio also went down, meaning that that cycle of collecting money has slowed down. It's taking customers more time to pay us for the accounts receivable. And that indicates a problem. That indicates that it's taking customers longer to pay us. That means that maybe we're less likely to get paid. So the AR turnover decrease indicates that it is taking longer for us to collect payments from customers. And that obviously indicates that there's some kind of problem. Might indicate that we are less likely to collect money, that there are more bad debts. So let's see what happened to the allowance. The allowance was 1.95% of accounts receivable last year in year 6, but by year 7 it decreased to 1.56% of receivables, meaning that meanwhile the allowance as a percentage of accounts receivable has decreased, indicating that the company expects to collect a higher percentage of its accounts receivable. So let's go over this again. Turnover indicates taking longer for us to collect money. This might indicate that we are less likely to collect money. There are more bad debts. Meanwhile, the allowance is decreased, indicating that the company expects to collect a higher percentage of its accounts receivable. It doesn't make any sense. What's more likely is that the company is not recording enough allowance here and that this number should actually be higher. If so, then it would also have more bad debt expense, and operating expenses would be even higher also, and operating income would be lower. So moving along, the amount reported for allowance bad debts is estimated. So it can be manipulated. So it indicates that, let's just plug numbers in here so you can see what might be the situation. What might be the situation is that the allowance for bad debt should really be higher. Let's say it's 2% of accounts receivable. 1475 times 0.02 would be equal to 29.5, or let's say 30. But let's say that this was 30. It would be 7 higher. Then operating expenses would also be 7 higher, or 525. And then operating income would be 7 lower, or 74. So the company did even worse than we expected. So let's go to the final question here. Would you feel comfortable granting a loan based on the below information? That's a question for you. I would have additional questions because the financial statements may be, I would ask for more information about how the allowance was determined. So it's very possible that there's good reasons for all of these things happening, and we don't need to assume that the company is just trying to lie to the bank. But what we'd want to do is we want to find out what happened here. Why exactly is the allowance decreasing to 23 while turnover also and sales decrease and accounts receivable increases? Why are these trends happening? I would expect all these numbers to move together and they're moving in opposite directions. So this is one example of how analysis of receivable information can give you a better understanding of what's happening inside a company.